I want to reflect on what you said last time, back in February. You said you'd rather be in bonds than stocks. Since then, stocks are down, bond yields are lower. You're still in that position.
I think so. If you kind of evaluate the situation right now, the risk of the economy accelerating with all sorts of things hanging over the economy is pretty small. On the other hand, there's a real possibility that we slow down. So in that environment, being in stocks or being overweight stocks relative to bonds, I don't think makes much sense.
Especially because you say 5,600 is the new 6,100 on stocks, and that's a pretty bearish outlook considering that most people on the street are seeing 6,000 or above as a likely target for year end.
Well, so the point I'm trying to make is we have a new trading range. We are not going back to all-time high, and if we do go back to all-time high, we are not staying there. I think given the level of uncertainty that you have in the market, expecting the same valuation on tech stocks that you had before that uncertainty, I think doesn't make any sense. If earnings growth was going to accelerate, then that would be a different issue. That's not the case anymore. So the point I'm trying to make is get used to a lower trading level. It's not the end of the world. It's down, let's say, 5, 7, 10% point from all-time highs. It's a decent level.
You know, it seems as though the uncertainty tax around tariffs affects stocks. It seems like bond markets don't care. It feels like on the margins, maybe high-yield bonds and maybe some of the spread market credit. But when it comes to government debt, it's sort of almost a comfort. It can kind of suppress growth a little bit, potentially down the line. They're paying attention to the budget. Do you think that that's the right way to look at it?
Well, so they're not paying attention today. And the reason they are not paying attention today is because there's enough momentum in the economy to continue to sustain the growth level that, as Joe was saying, he's not looking for a recession. He's looking for sub 2% type growth rate, which is pretty decent given inflation level. 4% on 10 years makes a lot of sense. However, if things slow down, if this continues and this continues till the end of the year, I think things will slow down. Things will slow down on all fronts, consumption and investment, and therefore bond markets will probably react at that point. I think the other thing to remember in this context is bond markets are going to react far earlier than the Fed. Fed is out of the picture for all practical purposes. Because of inflation, they can talk transitory, whatever. They're not cutting anything. And but they're not raising rates as well. So they're completely out of the picture. And the move will be on the bond market's court to see if the economy has slowed down enough where stagflationary issues that they're worried about today kind of fade away. We are talking about slow growth and a potential recession. Not today, towards the end of the year.